You're welcome once again to my channel. Today, I will be showing you simple strategy which has worked for me in other fields of life, such as the buying of shares in the stock market. This strategy here talks more about the buying opportunities that arises in the crypto space. Here, the goal is to make money from buying when the price is low and selling later when the price is high. So in the crypto space, there are times where the market goes down and there are times the market go up. But the goal in this particular strategy is buying when the price is low and selling when it is high. In the stock market, when the value of shares depreciates, you buy and you use that time to add up to your existing shares. And that same method applies in the crypto space, which is known as the dollar cost averaging. In the dollar cost averaging, you buy crypto when the price is down and you sell when the price is up. There are two ways to engage in the dollar cost average strategy. The two ways to engage in this strategy are the long term and the short term. Please stay tuned to the end to see how the strategy works in the crypto space. We all know that in the crypto space, the market experiences high volatility at times. So once a coin drops in price, we buy a little and wait to observe the movement of the market. If the price goes lower again, and we still buy more. So this strategy works basically on buying. You buy when the price is down, you buy when the price goes down again. To fully engage this strategy, I'll walk you through the Bollinger Band so that we understand how when the price is low, so that we don't just wait to see maybe on the chart, just as we see here, to say that okay, the price of BTC or BNB is now low, or we'll now wait for only the losers chart to say, using this losers chart, the prices are now low. We can also engage the Bollinger Band strategy to also know when the prices of a coin is down and when it is high. So we'll click on either the futures or the sports trade so we can open up to the Bollinger Band in our Binance app. So on this chart, this chart is also used for a technical analysis. But the strategy we are looking at today is the Bollinger Band strategy that helps us to determine when the prices of a particular crypto is low and when it is high. Observing this chart, you can see that the price of crypto dropped at this point. So using this strategy, you don't fear about the dip. That is when the prices of a crypto is dropping in the market. As you keep accumulating, using your budget set aside to buy. So in the Bollinger Band strategy, we know that here is the lower Bollinger Band, the middle Bollinger Band, and the upper Bollinger Band. When the price of a crypto rises, you see it through the direction that goes upward. And when the price of a crypto drops, just as is seen here, you see the movement downwards. So using this Bollinger Band strategy, you know that when the crypto price drops, it comes down to this lower Bollinger Band. And when it rises, it goes up to this lower Bollinger Band. So using this Bollinger Band strategy, as the price of the crypto drops, that is when we buy. But since we have two strategies that I said that are involved in this dollar cost averaging, we'll first discuss the long-term period of the dollar cost average. So for the long-term period, doing the dollar cost averaging on a particular coin It works based on the target you set for yourself. If you have a target of, say, in the month of April, you will accumulate a total worth of $200 USDT value of BTC. So whether the price is high or it is low, your target is to accumulate a total of $200 worth. So what you do is to come, if you fix that you'll be buying it on a weekly basis, per week it will be $50, another week 50, then the fourth week will be 50. As soon as you get to the market, the particular point you meet the price of the USDT, of the BTC at that point, you buy. Let's assume you meet the BTC at this point, you buy, because your target is to have $200 worth of BTC before the end of April. When you come again and let's assume you meet it at this point, you still buy. Your target is to meet up your long-term goal, which is to accumulate BTC within of a value of 200 USDT within the month of April. Peradventure it goes up at this point, you still buy, because your long-term goal is to accumulate a particular crypto. And my advice is for you to also carry out, before you carry out your dollar cost averaging on a crypto, you should be very sure of that particular crypto before you carry out a dollar cost averaging on it. So let's say you have decided to buy a portion, an amount of crypto per month. It's best you target the dip, but since it's on a long-term period, whether you meet the dip or you meet the high, you still buy to meet up your target as desired. The amount bought accumulates over time, and at the point of target, you must have accumulated a lot of profit, because this particular crypto are bought at different prices, some high, some low, and some even lower. Some can even be at this point. But the most important thing is the target and the set goal has been achieved, which makes up the long-term period of the dollar cost averaging. Then for the short time period, that is, your target is to buy within a short time and sell off. You target especially when the price of the market dips. Just as you can see here, the price of BTC is at the dip. So for the short time period, you can place your trade at this point, because as we speak, the price of BTC is 27,230. You can see it's still fluctuating, but it's at 27,000. It's still fluctuating and it's still going down. And using the Bollinger Band period, it's expected that once the market dips down to the lower Bollinger Band, the next thing that is expected is for the market to rise. So using the short time period, once that coin is bought, peradventure it dips more, again, you still buy. Your aim is to accumulate a good portion at the deep market, so by the time it begins to rise, you begin to make profit. And the best place to trade on the dollar cost averaging is on the spot trade of the Binance exchange. Here is the spot trade session of the Binance exchange. For those who are new to my channel, you can understand more of the Binance exchange when you watch my Binance interface for beginners. I'll drop the link in the description box. So you click on it now. It opens up. Let's say you want to carry out a dollar cost averaging on Arbitrum as a coin. Here is the Bollinger Band that we are. So you click on it to check the price at the moment on the Bollinger Band. And we are going to check this Bollinger Band on a 1-day movement. This is the 1 day. We check it on the 1 day, on the 1 hour. So on the 1 hour, Arbitrum is still on the dip. As you can see, it's still on the dip. Then on the 1 day Bollinger Band, Arbitrum is still on the dip. So for the short time period, you buy at this point, or you still wait patiently for it to still drop. But it is best to buy at this point, so that if it still dips again, you still buy. In case it still dips again, you still buy. Because it's expected that for every crypto that dips, the next expectation is for the crypto to rise. So for the short term period, once you buy, as the coin begins to rise back up in the market, you now make your profit. That is the best way to make profit on your using the dollar cost averaging. The principle here is that you are not afraid of the dip. Once it deepens and it keeps deepening more, you keep buying. You accumulate more at the lower price, so that by the time it begins to rise back, because using the 1 hour, or let's use the 4-hour time frame, you can see that this same arbitrum has risen as high as 1.6 in the market. As you can see, arbitrum has risen as high as 1.6 in the market. So arbitrum at the moment is experiencing a dip, because as we speak, arbitrum is 1.2, which is a very big dip. And any purchase, any buying you do here will yield a good profit when the market rises back again. And it's expected that the market is going to rise. So by using this method, you make your profits as easy and very simple. It involves a little bit of your time, because you monitor the market, you buy. But and this particular dollar cost averaging, it provides you little to no risk, because your funds are intact. In as much as the market continues to dip, you are experiencing just minimal losses, because you are still in the period of waiting. Because as soon as the market rises back, you make your profits. I strongly believe that using this dollar cost averaging, you will enjoy trading, especially for beginners who are not too good using futures trading. In futures trading, you amass massive profit, and likewise you also amass massive loss when the market goes against you. By using this method on the spot trade, your loss is minimal, because you are going to patiently wait for the market to rise back, then you amass your profit. I strongly believe that this tutorial added more knowledge and is self-explanatory, and I encourage you all to carry out this method and give me feedback on the comment section on how your trade went. Thank you for listening. See you soon in my next video. Bye.